The fine print in a Bitcoin loan could wipe out a company before the price even crashes. We're talking about corporate borrowers sometimes holding billions in Bitcoin operating under loan agreements so tightly wound that a single bad week in crypto markets can trigger a cascade of forced selling, margin calls, and in some cases, total collapse. Let's start with the most basic question. Why would a lender even touch Bitcoin as collateral in the first place? Simple, because the borrower has it, and the lender wants the business, but they're not about to take that volatility risk lying down. Here's where the haircut comes in. And no, we're not talking about your barber. When a lender counts Bitcoin as collateral, they typically only credit somewhere around 50% of its current market value toward your borrowing base. Meaning, if you pledge 100 Bitcoin worth $1 million, you might only get $500,000 in available credit. That gap isn't cruelty. It's the lender's buffer zone against the asset cutting itself in half, which, as we all know, Bitcoin has done multiple times with absolutely zero apology. Think of it like a landlord asking for 2 months security deposit because they've met renters before. Now here's where it gets spicy. Those haircuts aren't static. Lenders build in periodic revaluation clauses, meaning they can reassess the value of your Bitcoin collateral weekly, daily, or even in real time, depending on the agreement. And if the value drops, your borrowing base shrinks, whether you're ready for it or not. Imagine waking up on a Tuesday, checking the charts, and realizing your entire credit facility just shrank by 30% overnight because Bitcoin dropped and you never touched a single coin. That's the maintenance covenant doing its job, requiring the borrower to keep the collateral to loan ratio above a certain threshold at all times, or face the consequences. And the consequences are not subtle. Event of default clauses in these agreements are written like a trapdoor. Insolvency triggers one. A regulatory action against the borrower or Bitcoin itself could trigger another. And some agreements even include clauses tied to key personnel departures or loss of a business license. You sign the paper, you set the clock. Lenders also frequently require liquidity reserves, essentially forcing corporate Bitcoin borrowers to hold a cash buffer separate from operations, proving they can service debt even if the market goes sideways, because the lender has seen what happens when the market goes sideways. It's the financial equivalent of making you keep a fire extinguisher before they'll insure your kitchen. History backs the paranoia up. During the 2022 crypto credit crisis, companies like Celsius and Voyager collapsed in part because their loan agreements had triggers they couldn't meet when Bitcoin fell from $69,000 to under $20,000 in a matter of months. The covenants didn't cause the crash, but they absolutely accelerated the devastation. The irony is that the very protections designed to make these loans safe for lenders can make them catastrophically dangerous for borrowers in a downturn. A falling price forces collateral top-ups, which requires selling Bitcoin, which pushes the price lower, which triggers more margin, calls a doom loop dressed in legal language. The misconception most people carry is that a company with a lot of Bitcoin is a financially strong company. In reality, a company with a lot of leveraged Bitcoin, subject to aggressive haircuts and hair trigger covenants, might be one bad week away from forced liquidation. Strength and leverage are not the same thing, and the term sheet knows the difference, even if the headlines don't. The practical lesson here is simple. If you're a corporate borrower or an investor in one, you need to read the covenant package like your financial life depends on it, because it does. Moderate leverage, conservative borrowing base assumptions, and a clear understanding of your default triggers aren't pessimism. They're the only rational strategy in a market this volatile. Discipline, sizing, and consistency matter more than conviction always. A company that survives a Bitcoin crash with its equity intact because it borrowed conservatively is infinitely better positioned than one that swung big and got margin called into oblivion when it mattered most. Ultimately, understanding these protections isn't scary, it's empowering. Because when you know where the tripwires are, you can walk around them rather than through them. Whether Bitcoin goes to 200,000 or back to 20,000, the borrowers who survive will be the ones who respected the fine print, not the ones who ignored it. And if you're ready to put disciplined thinking to work in your own financial life, whether that's real estate investing, home contracting projects, or finding the right lenders for your next move, we can help you get started. So check out our links in the description below.